Welcome to vTalkInsight, Risk Sentiment Daily for December 5, 2025. Markets are leaning cautiously risk-on as investors price in near-certain Fed easing, even while labor cracks, elevated yields, and AI-related credit risks keep the wall of worry high. Let's unpack what is driving risk appetite today, and what that balance of forces could mean for portfolios into year-end and 2026. Across major assets, overall risk sentiment looks cautiously risk-on rather than euphoric. Equity indices like the S&P 500 are holding near recent highs, while volatility gauges continue to grind lower, suggesting investors are more comfortable carrying risk even as they remain selective. That surface calm is underpinned by expectations of a Federal Reserve rate cut next week, resilient earnings, and ongoing AI and infrastructure investment, all of which support a soft landing narrative rather than an imminent recession call. Beneath that, however, the undercurrent is still fragile. Recent data point to weakening private payrolls, rising announced job cuts, and pressure on consumer balance sheets, especially in lower-income cohorts relying more heavily on credit and buy now, pay later financing. Valuations across both equities and credit screens look full, with implied S&P 500 levels above 7,000 based on current earnings forecasts and tight spreads, leaving limited room for disappointment if growth or policy surprises on the downside. Positioning also reflects this two-way risk. Fundamentals-based equity investors remain neutral to slightly underweight, which indicates that a high degree of caution is already embedded even as headline indices trade well. Key catalysts now cluster around the Federal Reserve decision and guidance, upcoming labor and inflation releases such as PCE and consumer sentiment, and the start of fourth-quarter earnings season. Together, these will determine whether today's cautiously risk-on stance can persist, or whether the balance tilts back toward a more defensive posture. Fed easing and soft landing hopes are the dominant bullish driver today. A string of softer U.S. labor indicators, including the largest monthly ADP employment drop since early March 1, 2023, and notable private payroll weakness, has pushed markets to price a roughly 98% probability of a December rate cut. Risk assets have responded accordingly. Equities, European cyclicals, and even crypto are trading with a constructive tone, while the US dollar has softened as investors anticipate lower front-end rates. Within the Federal Reserve itself, the signal has tilted more dovish. Several committee members now project terminal policy rates below 3%, and the latest dot plot shows 5 officials already favoring that outcome, reflecting concern over softer growth and labor trends. On top of rate cuts, some expect a form of stealth quantitative easing, with balance sheet reinvestments absorbing an estimated $250 billion of Treasury supply annually over the next few years, which could help contain term premia and support broader risk sentiment. Even so, the dovish narrative has clear limits. Inflation remains near 3%, fiscal policy is expansionary, and AI-driven capex is supporting growth, all of which argue against an aggressive multi-cut cycle. Several observers warn that markets may be overestimating the scale of easing next year. Recent backups in Treasury yields, especially after very low jobless claims and speculation around a more overtly political Fed chair, highlight concerns about policy credibility and the risk of a policy mistake if cuts are either too deep or too shallow. For markets, this means pricing around the path and pace of Fed cuts is likely to remain a key volatility driver. Front-end yields, the dollar, and rate-sensitive equities can all swing sharply as each data release either validates or challenges the soft landing and gradual easing story. The main watch points now are next week's meeting outcome, the balance of growth versus inflation language in the statement, and how strongly the Fed leans into the idea of lower terminal rates. Those signals will either reinforce today's cautiously risk-on tone or force a repricing across rates, FX, and equities. Alongside policy, robust earnings and record buybacks are a powerful support for risk appetite. S&P 500 earnings growth is projected to be close to 10% in January 1, 2025 and potentially double-digit again in 2026, with some estimates pointing to around 14%, modestly above the historical non-recession average. Fourth quarter reporting is widely viewed as the next major catalyst, with several commentators arguing that consensus forecasts look too conservative given third quarter outperformance and positive guidance from key sectors. Buybacks add another layer of support. Gross share repurchases are expected to reach roughly $1.4 trillion next year, with payout ratios broadly stable, implying a mechanical contribution of around 10 to 11% to S&P 500 returns if execution continues. This shareholder-friendly backdrop is complemented by company-specific beats and upgrades, from Meta and Salesforce in technology, to Zoetis in animal health and Dollar General in discount retail, which reinforce the idea that corporate America retains significant earnings power despite macro uncertainty. Importantly, leadership is starting to broaden beyond the mega-cap AI complex. Analysts lifting S&P targets to the 7,800 area are basing that on expected upside in consumer discretionary, select financials, transports, and European capital goods, not just the traditional tech leaders. At the same time, the valuation tension is obvious. Current earnings and price-to-earnings ratios imply S&P levels already above 7,000, leaving little buffer if growth slows or if margins are squeezed by higher interest costs and wage pressures. In practice, this means earnings strength and buybacks act more as a buffer than a guarantee. They can absorb some policy or growth shocks, but stretched multiples and high expectations increase the market's sensitivity to any disappointment, whether at the stock or index level. Investors will be watching fourth quarter results, guidance for 2026, and the scale of new buyback authorizations closely, especially as leadership within the mega-cap cohort fragments and dispersion across sectors and single names continues to rise. AI-driven capex and infrastructure boom remains a central medium-term bullish driver. The AI investment cycle is now seen as entering its third year, with expectations that productivity gains will increasingly extend beyond core technology into a wide range of sectors. Despite worries about overinvestment, current demand from AI use cases is absorbing new data center capacity, suggesting the build-out is still in an early growth phase rather than approaching oversupply. This is visible in company and sector-level data. GE Vernova has reported a 30% backlog increase driven by grid and transmission upgrades, while Vertiv is seeing close to 28% organic sales growth and material margin expansion on liquid cooling and power infrastructure for data centers. Analysts expect European capital goods firms tied to power generation and AI data centers to outperform through 2026, underscoring how the AI capex story is bleeding into industrials, utilities, and broader infrastructure plays. At the macro level, this investment wave combines with fiscal expansion and private sector capex to support U.S. growth and, for now, a resilient dollar. Official forecasts point to growth above 2% next year, with AI and energy infrastructure as key contributors. However, monetization lags are real. Enterprise adoption of AI tools is slower than consumer uptake, with meaningful revenue impact from business clients likely only from 2026 onward, and much of today's consumer usage remains concentrated in free services, where digital advertising is the primary revenue engine. That mix leaves a gap between heavy near-term capex and slower revenue realization. It supports a constructive growth story but also heightens the market sensitivity to execution, utilization rates, and credible evidence of productivity gains. Key watch points include capex plans from hyperscalers, order books at power and capital goods suppliers, and any hard data on efficiency improvements. Together, they will determine whether AI remains a durable growth engine or becomes more of a volatile boom-bust cycle. On the bearish side, labor and consumer weakness emerging is a growing concern. Recent reports show the largest monthly drop in private employment since early 2023, with U.S. small businesses shedding around 120,000 jobs in November, the biggest contraction since 2020. Announced job cuts exceeded 71,000 for the month, a level only surpassed in 2008 and 2022, and November layoffs rose more than 23% year-over-year, pointing to a genuine softening rather than noise. Importantly, the weakness appears demand-driven. Job postings have declined for 12 consecutive months, and surveys suggest employers are holding back hiring because of uncertainty about future demand, not because they cannot find workers. Household data echo that strain. The U.S. savings rate has dropped below 5%, credit card balances are growing near 8%, and by now, pay-later transactions are expanding at more than double the pace of overall retail sales, all consistent with consumers leaning harder on credit to maintain spending. There are counter-signals. Initial jobless claims recently fell to their lowest level since late 2022, though the holiday period may be distorting that series, and corporate and household balance sheets remain generally solid in aggregate. Even so, microdata such as weaker comparable sales at Costco heading into the holiday season and the increased popularity of dollar stores among middle and higher income shoppers suggest a shift toward value-seeking behavior that is more typical of late-cycle dynamics. If these trends persist, they could tilt the outlook from a benign soft landing toward a more pronounced slowdown, particularly if labor market weakness spills over into confidence and corporate capex plans. For markets, the near-term implication is greater sensitivity to each incremental data point on jobs and consumption, as investors weigh the support from easier policy against the risk that growth could disappoint more meaningfully than current consensus assumes. Another key headwind is higher for longer yields and valuations. Despite expectations for lower rates over time, the 10-year U.S. Treasury yield remains stubbornly around 4%, and the curve has been steepening as 2-year yields hover near 4.5%. Rising government deficits, heavy bond issuance to fund both fiscal programs and AI investments, and lingering inflation pressures are keeping term premia elevated, limiting how far long-dated yields can fall even as markets price cuts at the front end. Market pricing for roughly 4 Fed cuts over the next year increasingly looks aggressive against this backdrop. Several commentators argue that strong growth, persistent 3% inflation, and additional fiscal stimulus could constrain the central bank to a much shallower easing path. Recent moves higher in yields after very low jobless claims, and the 10 basis point jump following speculation about a more politically aligned Fed chair, underline how quickly the rates market can challenge overly dovish expectations. Elevated yields feed directly into valuation risk. A steeper curve and 4% plus long rates are seen as a headwind for equity multiples, particularly for long-duration assets such as high-growth technology and other secular growth stories. Analysts note that if markets accept a higher neutral rate in the 3 to 4% range, current S&P 500 price-earnings ratios may be difficult to sustain, implying either slower price appreciation, multiple compression, or rotation towards shorter duration sectors like cyclicals and small caps. In fixed income, tight credit spreads and elevated valuations suggest limited scope for further broad-based rallies, with many investors focused on carry rather than capital gains as default risks remain contained for now. Persistent high mortgage rates, linked to both the steep curve and deficit financing, continue to weigh on the U.S. housing market, constraining any near-term recovery and reinforcing the idea that higher for longer yields are reshaping sector-level opportunities and risks. The final major risk driver is AI and credit market vulnerabilities. Projected AI infrastructure spending is estimated around $3 trillion through 2028, with about half expected to be financed with debt, underscoring the sector's dependence on deep and receptive capital markets. There has already been a surge in AI-related and broader technology bond issuance, which has pushed spreads wider over the last 3 months and sparked concern about potential market indigestion, especially if lower-rated issuers face weaker demand or downgrades. Private credit sits at the center of this discussion. Critics warn that its largely investor-funded, less regulated structure could prove procyclical, with capital retreating rapidly in a downturn and amplifying stress, particularly in sectors tied to speculative capex or leveraged buyouts. While managers point to low lockups, low leverage, and recent improvements in interest coverage and covenant defaults, margins are already under pressure as spreads compress toward 500 basis points and competition from banks intensifies. Beyond pure financing, there are operational and concentration risks in the AI ecosystem itself. Some industry leaders worry that the pace of data center build-out is becoming excessive or speculative, even as current demand absorbs capacity, raising the specter of overinvestment if monetization lags. A recent major data center outage that forced a pause in a large mortgage bond sale highlights how operational issues can quickly spill into funding markets, and analysts note that risk is shifting from real estate owners toward hyperscalers and AI operators, changing who ultimately bears the exposure. For markets, these dynamics mean that headline calm in credit indices may mask growing pockets of vulnerability tied to AI, leveraged structures, and parts of private lending. Key watchpoints include the pace and pricing of new AI-related issuance, secondary market performance of tech and data center bonds, and any rise in private credit defaults or restructurings. Together with labor and yield risks, they round out a more complex backdrop than headline indices alone might suggest. To sum up, today's risk sentiment is cautiously risk-on, anchored by Fed easing and soft landing hopes, robust earnings and record buybacks, and a powerful AI-driven infrastructure boom. Against that, labor and consumer softness, higher for longer yields and rich valuations, and emerging AI and credit market vulnerabilities keep downside risks very much in play, arguing for close attention to upcoming policy decisions, data releases, and credit conditions. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.